let's get on to talk more about the elections that has been postponed and the financial market. Jolomi Odonghanro is from Afrinvest. He's an associate. Is an associate and team lead for fixed income. Of course, last week the fixed income market finished off nicely, but this week the big story for the fixed income market is the February debt management auction, 150 billion. The same amount that was offered in January on the first quarter calendar is what the DMO will be offering this week. What will be the impact of these postponed elections on that debt offering? We're going to ask those questions on the one hand. On the other hand, you find the market trading very nicely last week. We saw a bit of a yield going round to about single digit, north of single digit on treasury bills, as the central bank continued to mop up at the treasuries window. All of that will be part of what the market will be considering this week. But more importantly, how do securities in the debt market react to elections postponement, with the history of elections postponement that we're beginning to have on our electoral calendar in Nigeria? This is Jolomi Odonghanro for you, who is an associate and team lead for fixed income at Afrinvest. It's also live to us from our studios in downtown the Nigerian Stock Exchange. Jolomi, thank you very much. Hope you had a great weekend.
Same to you. Thanks for having me.
Yeah, it's good to have you on the program. Thanks for coming through from Afrinvest. What's your views, you folks at Afrinvest, what's your views about this elections postponement as far as the marketplace is concerned?
I mean, for the market deplores uncertainty, and that's what the postponement has brought into the market. I mean, you're looking at investors that, you know, over the past few weeks, like you've seen in the equity and a little bit in the fixed income as well, there's been more flows, and consequently you've seen yields decline on treasury bills and on bonds as well. Similarly, in the equities markets, there's been quite a substantial return over the last week, and that's the more, you know, the less risk-averse money coming into the market. But what you have is that a lot of investors have been waiting for the point where we move past the political risk, where there's more clarity on the direction before coming into the market. And what you've just introduced is far more uncertainty than a lot of people are comfortable with. And so you might see a pushback from that point of view, where we expected right after the election there may be this big uptake in inflows coming into money markets, coming into fixed income, coming into the equities market. And investors more waiting towards June, when there's a handover to really come into the market.
Okay, so what exactly does, if we look at the long end of the market, let's stick a little bit with fixed income. It's been a very big rally, as it were, in terms of the liquidity in the market, the way the financial regulator, the central bank, and the DMO has been mopping into the market over the last few weeks before last Saturday. Do you think that holding steady in terms of liquidity management will, that kind of appetite will remain zero tolerance for liquidity overhang by the central bank, knowing that it's not over yet?
Yeah. So, you know, we know the reason why the central bank has continued to mop up at such a pace, and that's really to manage price levels from the perspective of also to actually manage outflows from the market, and also in a bid to stop any position taking on FX that might turn out negatively in the market. So we don't expect that to change at all. I mean, the CBN has been very, very clear about the objective of maintaining price levels, and that's not going to change anytime soon. That's not going to change anytime. We wouldn't expect that.
Okay, so in terms of the elections, when elections are around, we see yield behave differently depending on investors' mood. What's your reading of the mood of investors as far as the yield curve is concerned in this particular election period, 2019?
Okay, so in the period from Q4 last year up until about the end of January, what we saw is that yield spiked significantly. We're talking the average yield on treasury bills of around 15% on the 1 year, 15% on the 1 year, coming down to about 13% on the lower tenor lower tenor instruments. Then on the bonds, you saw an average of about 15.5% across the curve. Now, basically, this is the way yields normally behave during an election period, because again, the political risk is high. So the political risk is high. You have sell downs on one end, and you have management of the yields on the other end to manage outflows, FPI capital flow reversals. So that again presented this year. Although we didn't see a yield spike to the high of the last election, where we saw yields as high as 17%, the average here would have been about 15% across the curve from the short to the long end. So, but what we've seen in recent weeks is that yields have started to come down. So like Temple gave figures earlier, we've seen yields around the 14.5 to 14.7 levels from treasury bills to bonds, and that demand has only just been resurgent in the past few weeks as some foreign investment has come into the market, and investors were sort of front running the end of the elections, where you're expecting yields to decline significantly. And we all know the impact of yield decline on your portfolio. That's a good capital appreciation on your portfolio. So what we've seen in the period is just that move on investors front running the end of the political risks to take positions. And so the yields behavior has been very, very similar to previous election years. We just come to the end of it now, where we should start to see yields trend downwards.
Okay, so do you think this elections postponement will unnerve the debt market, investors and traders? Again, you're looking at the DM of 150 billion naira February auction this week.
Yes, I mean, the postponement, like I said, markets deplore uncertainty, and that's what you've introduced at the moment. So at a point where you had significant liquidity coming into the market, what you would have had at the auction is a decline in yield, a decline in the final offer yields, and that's because of the amount of liquidity we would have expected in the market. But now, with investors not coming into the market over the next week as significantly as they would have otherwise, what you find is that the yields may either stay at the current levels or trend upwards slightly. At the end of the day, they're still going to try and manage the levels, but the sort of liquidity that we would have expected to come into the market at the bond auction will not come in. We wouldn't expect that to come in the same quantum.
In terms of subscription and in terms of what you think the stop rate will be?
Yes, in terms of, I mean, it all goes together. So the level of subscription determines the bid level, and that determines where the final offer yield will come to. Because at the end of the day, if there's enough investors that come into the market and bid lower and lower, the closing offer yield will be lower than the previous auction. But in a case where investors are not coming in at a significant level, you might have the number of investors that are coming in and bid at a yield that is over market because they see that the liquidity is just not there. And what you would have in that case is that yields would spike. So everything is interconnected.
Interconnected. Thank you very much. Jolomi Odonghanro, who is an associate and team lead for fixed income at Afrinvest. Thank you very much for your time.